What are we looking at for 2019? Sectors worst hit.
Yeah, the issue here is that it feels like we're top of cycle, especially for the consumer. It can't get any better than it can right now, and I think that's really scaring the market. Technology, we've seen obviously things hit there. Apple, stuff with the iPhone coming out. Facebook's been hit. It just feels like kind of a cascade of news that's going to impact 19 earnings. And if you lose that one sector that's really held this market up, which is retail, and the consumer is super strong right now. But again, everybody looks forward, and if we lose that one, I think there's going to be a huge issue.
So, Lisa, what do you do when the backdrop is also slowing global growth in 2019, particularly the U.S. outperformance starts to erode?
Well, we have a balanced view right now on the U.S. equity market, and to your point, Alex, it's because really there's a set of pros and a set of cons that pretty nicely balance off each other. So really in this kind of environment, we think the best advice we can give our investors is really to stand pat on their existing allocations. If we think in terms of the earnings outlook, as you said, we have had some nice earnings gains here into 2018, but we have, to your point, started to see those 2019 estimates start to trend downward. And so you've got a good near-term outlook, but certainly balanced by the anticipation into 2019. On an economic front, we also see a solid economy, but again, questions about potentially where that may go. So if we look at our proprietary dashboard of economic indicators, what we see right now is that the majority actually still registers on the positive side, pointing to either an expansionary or recovery. But that being said, just in the last couple of weeks, we've seen a little bit of a downturn. So our best advice to clients right now is really to stand pat on their strategic allocations.
Now, what was interestingly is that in earnings season, we kind of knew it was going to be peak earnings, but it feels like it was the broad swath of all the sectors that really stood out. What's still going to do well, and can it still do well?
Look, technology is still going to do decently well. It's going to be hard for tech to lead the market if you have such big names like Facebook and Apple having fundamental issues here. We still think retail is going to do well in 2019. The issue is the comps are going to start to get really tough here. And investors don't want to invest in high beta names against those tough comps. We've had pretty good comps, this year, and that's why retail has done so well, mostly across the board, except for some of the stuff that's had issues with the trade war. And when you take a look at stuff that, will see an impact from the rising dollar, you didn't hear too much about the rising dollar this quarter. You will hear about it next quarter because the things ticked up pretty good. You heard about rates somewhat this quarter. You're going to hear more about it next quarter. So there's just a whole bunch of things that are stacking up here, and that all leads to investors investing in lower beta names. We've seen healthcare do pretty well. It should continue to do pretty well. Consumer staples, although they're going to have problems with the dollar, which will cause more issues.